Cathie Wood brings her signature bold vision, revealing how AI will soon transform all industries and unlock huge money-making opportunities. Tune into Wood's exclusive insights on spotting emerging tech titans early and separating promising innovators from speculation. This video delivers wisdom you won't find elsewhere, so grab some coffee and let's dive right in.
Cathie Wood, Chief Executive Officer and Chief Investment Officer of ARK Invest. Cathie, it is great to have you with us and an honor, might I add, and thank you for taking the time to chat.
Oh, thank you, Heron. I'm delighted that you invited me and really looking forward to your interview. I know you've done incredible research on ARK, so thank you for that.
Absolutely, and we're going to get into a lot of that discussion today and really satisfy those hungers that we have about artificial intelligence. Now, before we do that, just for our audience, we wanted to just preface our, this conversation by saying that any opinions, views, and forecasts that are going to be expressed are solely those of Cathie and her team at ARK Invest, which have been substantiated by their research. Any securities that do get mentioned are to help facilitate our dialogue, provide contextualization, and to inform and educate. This should not be construed in any shape or form as investment advice, explicitly or implicitly any sort of buy, sell, or hold recommendations. As always, investors should perform their own due diligence and ensure any investment decisions they make fit within the framework of their own objectives, time horizons, and risk tolerances. Now, with that being out of the way, Cathie, I wanted to, before we get into the crux of our topic today, which is artificial intelligence, we wanted to just get to know you a little bit and also your journey. So let me start things off on a personal note. It takes a lot of conviction to invest in emerging technologies that are largely unproven or market tested, perhaps especially as a woman in a largely male-dominated industry. What was the driving force in launching ARK Invest and taking the investing path in disruptive innovation?
Sure. Thank you, Heron, for that question. Well, I grew up in the investment world, really starting in the late 70s when I was in college, through the 80s and 90s, an incredible time of investing as the PC was coming to life and then the internet and software and so forth. And back then, active management was the primary investment process out there. And then after the tech and telecom bust, and even more so after 08, 09, something happened to our industry. It became very benchmark sensitive, and the move towards passive investing accelerated. And we were looking more and more like a different duck. You know, we are
Right.
benchmark agnostic, and we are really focused on the companies that are going to become a part of indexes in the future because they're going to transform the world. We're much less focused on companies that have already transformed the world and that are in the major benchmarks. So we wanted to offer a really good, diversified exposure to disruptive innovation that most people don't have in their portfolios. And we wanted to, I mean, this was a very bold way of thinking about it at the time. We wanted to own disruptive innovation, technologically enabled disruptive innovation. And we centered our research around that, heavily focused on something called Wright's Law, which is a relative of Moore's Law. So that helps us understand how quickly costs associated with different technologies are going to fall, and how quickly, therefore, the technologies are going to proliferate and really touch many sectors over time.
Okay. And I wanted to ask you, because you mentioned disruptive innovation, you know, we always hear those words separated. We hear about disruptors of the day, we hear about innovators. You've coined that term and put it together, disruptive innovation. So can you tell us in your own words, what does disruptive innovation mean to you?
Well, the first thing it means is it's technologically enabled, and we can measure the learning curves, which are expressed in cost declines. But there are three variables that we believe characterize disruptive innovation. First is that those learning curves do exist. This is a technology. Second, and that they're going to fall over time. Second is the technology, we believe, is going to is going to scan across sectors. It's going to permeate many sectors, not just one. And then the third is that these innovation platforms are going to be launching pads for more innovation. And so the 5 major platforms around which we have centered our research and which meet those 3 characteristics are robotics, energy storage, artificial intelligence, blockchain technology, and multi-omics sequencing in the life science space. And what's also interesting is those 5 platforms involve 14 different technologies. And so we often compare today to a period most like it, which was in the late 1800s, early 1900s, telephone, electricity, and internal combustion engine. So yes, and you can see here that AI is at the heart, and that is a correct characterization. It is the biggest catalyst to the convergence between and among technologies. You can see in purple here how pervasive it is, and deep purple even more so in catalyzing other technologies, speeding them up. So I think the way we've set up our research, we're able to capitalize upon the convergences because our analyst responsibilities are broken out not by sector, but by technology. So they're tech specialists, those 14 different technologies, and they are sector generalists because we expect these technologies to permeate many sectors.
Okay, that's a fantastic primer. So thank you for that, Cathie. And I wanted to ask you on a lighter note, since we are talking about innovation, my mind can't help but think about great innovators of the past and even present: Thomas Edison, Nikola Tesla, Benjamin Graham, Steve Jobs. So could you revel us about who your favorite innovator is and how they might have influenced you, or why them?
Oh, it's interesting you asked that question because each person at ARC in his or her bio puts the favorite innovator. Now, I'll give, so Copernicus is the one I chose from a long time ago. I would say today it's Elon Musk, but the reason I chose Copernicus in 2014 is Copernicus fought conventional wisdom that said that the Earth was the center of the universe. And he just used physics to figure out that just wasn't true. And he was considered a heretic for doing it. But as a scientist, he thought the sun was the center of the universe, and the physics supported it. And instead of, and I remember doing this experiment in high school, instead of kind of putting Band-Aids or making excuses for models that the Earth was at the center of the universe, but that did not quite work, he put the sun at the center of the universe, and it was such a simple, elegant, but definitely fought conventional wisdom. And I think that's what we're doing at ARC, because the world has gone very benchmark centric, and there's a place for them. They enable access, very inexpensive access to broad-based exposure to markets. But we feel that our role is a little disruptive in terms of how we set up our research, but also our sole focus on disruptive innovation. Most investment firms would consider that very risky. But if we're right, and these 5 innovation platforms are going to transform the world completely, then it's the equivalent of the sun at the center of the universe. This is the way the world's going to work. So why not put it into portfolios now and enjoy the ride along the way?
Absolutely. And actually, good thing you queued us up on that, because why don't you tell us, you've talked about being different from traditional fund managers, not taking that passive approach. So could you tell us a little bit about your work, your team at ARC does, kind of the people that are working with you, because they're not just analysts. You've got people from all kinds of fields. And what is your approach being to researching emerging technologies such as artificial intelligence?
Sure. So yes, we hire people, many of them straight from college or from their first industry experience, with domain expertise. They are expert in these technologies. Sandy Bernstein, who founded Bernstein, which merged into Alliance for Alliance Bernstein, was my last firm. And Sandy did this with his own firm. He said, and we agree, that it is much easier to teach a rocket scientist how to read financial tables, how to understand them, and how to model them, than it is to teach an MBA about rocket science. And we would say the same is true of biochemical engineering and robotics, battery technology, artificial intelligence, blockchain technology. So they are experts in their fields. They have one foot in the new world because they're young enough to be the reason the world is going to change. They have one foot in the new world, and they're helping make it happen. And then in terms of the process, our chief futurist, Brett Whitten, and I have worked together for about a little more than 15 years now. And our starting point, as I alluded to earlier, is trying to understand the learning curves associated with the 14 different technologies around which we have centered our research. How quickly are those costs going to fall? And when will lower prices unlock whole new segments of the market? And we've seen this, for example, with our work on battery technology. We understood how quickly the costs were going to decline because we understood what Elon Musk was doing in terms of innovating in the battery space and how he had based his company on another learning curve, very well developed, and that's consumer electronics like cell phones and laptops. And he did what many people thought was impossible. He basically built a car on top of that battery technology and then engineered battery pack systems in a way that no auto company thought was possible. So no one copied him. So again, he was like Copernicus in the old days. No one believed it was possible, but he proved that it was and has enjoyed incredible success as a result.
All right, and we're going to get more into that about Elon as well. I'm sure Tesla will come up in our conversation. So I'm really excited to delve into your research process then, Cathie. And before we do that, for those in our audience, make sure to stick around until the end of our conversation. We'll hear the biggest lesson Cathie's learned about investing in tech that you need to know. So with that said, let's get into it. First off, opinions about artificial intelligence and how it'll shape the way we live and work range from glowingly optimistic to downright dystopian. So how do you envision the future of AI shaping up and the impact it's going to have?
Yes, we think that AI is going to be the most impactful breakthrough innovation, technologically enabled innovation in history. And you can see the economic impact we expect, which will dwarf that of the steam engine, which was that technology up until AI. And one of the reasons is we've had major breakthroughs. AI has been in scientific and research minds for 50, 60 years. So why is it happening now? Well, a couple of things. We had deep learning breakthroughs in 2012 around image. It was called ImageNet, a kind of test. And then in 2017, 2018, another breakthrough called transformer architecture, which has pushed us into natural language processing. now, because of these breakthroughs, because we all speak a natural language, we will all have the opportunity to become developers in a way that was not possible before. There are companies out there. One of them is called Replit. It's a private company that is enabling people who have very little coding experience to write programs because AI does 80% of the work. And these coders are becoming prompt engineers. When they're trying to refine programs, they can just talk to the AI and evolve the program. So I think that's why it's exploding now. And ChatGPT finally, even though we've been doing the research for years and years, ChatGPT finally captured the consumers and the investors' imagination. Now people understand how provocative AI is going to be. And just some good early examples of that are grant writers, whether they're scientists and researchers, or if they're just educators writing to the state grant system for grants for schools. It used to take 3 or 4 months to write grants. Now it takes a week or so. Yes, and here's an example of the power of GPT 3.5, 4, and Claude 2. Here you can see these are different exams and the scores that they achieve. Each one, you can see them color-coded here. Some are better at some tests than others. Claude, anything involving literature and the English language is better than GPT 3.5 or GPT 4, but they all have their place, and you can see how good they are becoming. They're able to, in some cases, ace these tests, SATs, law tests, and so forth. So I think ChatGPT was the iPhone moment, and now we're having huge capital flowing into the space to make it happen even faster than we thought possible. And one of the reasons for that is that AI training costs are dropping. It depends, the latest metrics we have, dropping 75% per year. AI inference costs are dropping 85% plus per year. When the cost of something drops that dramatically, you're going to get a lot more of it. And I'll just give you an example there. GPT-3, which served up ChatGPT, GPT-3 in 2015, had it been developed back then, it would have cost $500 million. Now, it wasn't developed back then. It was developed in 2020, and it cost only $4.5 million. Today, it would cost maybe $100,000. That's how quickly costs are falling. It means the barriers to entry are dropping. And as I mentioned before, people who never thought they would program are able to program now because AI itself is able to help them along the way. And yes, this is a good cost decline chart, and you can see how scientific it is. This involves both data and computing units. So we have our own metric, and it's taken us a long time. I remember starting the firm in 2014. We said, how can we measure AI training hardware and software costs? And it's taken a lot of iteration, a lot of time, but here we are, and you can see these are log scales. You can see how dramatic the cost declines are.
Yeah. And on that note, actually, let me ask you this then, Cathie, because you talked about the economic impact. Of course, we're seeing this, major cost declines happening. So could you tell me about artificial general intelligence then? There's a lot of speculation about it. It seems to be the end state that all of these models are kind of working towards. So could you tell us first briefly, what is artificial general intelligence, and what's your take on how close we may be to seeing it, and what that impact is going to look like in economic terms?
Sure. Well, artificial general intelligence, you saw the chart on the test scores that these models are able to achieve. That's certainly one test, getting those to 100% and becoming better than human beings at taking these tests. Another one is being able to describe how to put together a very complicated car. And then a third test is interacting with AI and basically having a conversation with it for 2 hours and not being able to tell whether what you're talking to is a real person or an AI agent. And so those are three of the common tests. And I think you do have this chart in this presentation. Yes, AGI around the corner. In 2019, before ChatGPT launched, the experts out there, and this is not our forecast, it is a compilation of forecasts, sort of futurists out there. In 2019, they thought it would take 80 years to get there. So 2100. You can see with each iteration of GPT-3, and then you had Lambda 2 from Google. OpenAI was the first breakthrough. Then you had ChatGPT, which came out of GPT-3, and GPT-4. You can see that 80 years has collapsed now to 8 years. And if the error rate continues at that pace, we could be there in 2026. If the forecast is now tuned correctly, maybe we're talking about 2030. This is, I can tell you, as we've done our research over the years, and when we encountered transformer architecture and natural language processing, and the light bulb went on, we said, oh my gosh, this is going to transform the world much faster than we thought previously. And here you can see that in living color.
Yeah, those are staggering numbers, and we're not too far away. It's surprising to see that we're less than a decade away from that being a reality. Being a kid and having lived through the 90s, I picture the Jetsons and having all of this, artificial intelligence interacting and integrating into society and households. So we're looking forward to seeing how that sort of evolves and comes to life. Now, let's get to the nitty-gritty of things now, Cathie. We've got a big picture idea of artificial intelligence, sort of the case for it. Let's dive into some of the specifics your team looks at when investing in AI. We know the AI market is characterized by a high degree of innovation owing to rapid technological advancements driven by factors such as advancements in machine learning, availability of big data, and in increasing computing power. So let's start on the qualitative side. What are some characteristics you like to see in an AI stock? And what are these sub-themes that we as investors should be looking at as well?
Yes, well, I think everyone knows the biggest AI play out there so far in the public equity markets has been NVIDIA. And we were on to NVIDIA a long time ago. We bought it at $5, and now I think it's around $700 because we saw how important a role it was going to play in autonomous technologies, autonomous transportation in particular. But to back up and how we're assessing companies now, NVIDIA has a very special place for sure. But most people know it. It's been well exploited. And congratulations, all praises to Jensen Huang. We've watched him. And in some of our more specialized portfolios, we still own some of that stock. But in terms of the companies that we're looking at and their characteristics, there are four when it comes to AI. Okay. The first, and this is critical, is domain expertise. Is this company a leader, a visionary in its field? whatever that field is. And an easy one to use here as an example of what I'm talking about is Tesla. Tesla, we think, will be part of the largest AI project in the world. So does it have the domain expertise? Well, in order to be a part of the autonomous transportation world, you have to have a vehicle, and you have to have the most economic vehicle out there. When we talk about robo-taxis, one of the most economic vehicles out there. And we do think that robo-taxis, the cost of them, will be in the $15,000 to $20,000 range within the next 5 years. And Tesla's definitely aiming there. But the other thing it has in terms of AI is it has designed its own AI chip. So it pulled NVIDIA out of its cars and is using its own AI chip, a more specialized chip than NVIDIA had at the time. And it's taking a leaf from Apple's book. Apple was redefining the cell phone space from cell phones to smartphones, computers in our pockets, right? And Apple designed its own chip to do that. It understood where that market was going, how it was going to be redefined. Tesla's doing that in the auto world. We're moving from human-driven autos to autonomous, we believe, in the next few years. And so this domain expertise, having its own AI chip and AI expertise is critical. So it has domain expertise in terms of the auto space generally, and especially electric. It has the AI chip, so that's 2. 3, it has global distribution, clearly. And 4, it has data that no one else in the world has. And that becomes the most important variable at the end of the day. Proprietary data that no one else has. It has billions upon billions of miles of real world driving data that no one else has. It has more than all of the auto companies, all of the technology companies combined, orders of magnitude more. And that's why we think it will get people from point A to point B more safely and more quickly than any other auto company out there. It's going to be winner take most, certainly in the United States and probably other geographies as well. So those are the four variables. And, you know, in our portfolios, we are viewing every stock through those lenses, that 4 variable lens, with this belief that AI is going to be the most transformational technology in history. So who is going to harness it most effectively? Those are the companies we're looking for, certainly, and Tesla is one. Another example is Palantir. Palantir is a company that has been waiting for 20 years for this day, when the CEOs, the chief strategy officers, the chief technology officers are saying, wait a minute, we have to figure this out strategically. It's going to be the most important technology determining the winners versus the losers. So what do we do here? Palantir is able to take a company and help it integrate its data and map out work processes in a way that no other company can. And so that's the starting point, you know, in terms of the competition. And we believe Palantir's solution, it's a software and a professional services solution. Its gross margins are in the 80% range. So its software is very valuable. And we think for every dollar of hardware, like NVIDIA's, that is sold out there, at least $5 of software will be sold to accompany it. And a company like Palantir is a good example of that. Another company is UiPath. It helps companies map its work processes, just the boring stuff that goes on at every company, and and it's using all the foundation models out there like OpenAI and Llama 2 and others, and building specialized models for companies to customize the AI solutions to their own work processes. So that's also a very interesting company. And in Canada, one of Canada's expertise in AI is truly admirable. Your universities are some of the best. I think some of the best talent associated with artificial intelligence has come out of Canada. We find a lot of people in Silicon Valley, but a lot are migrating back to Canada because that's where the talent pool lives. And Shopify is a great example in Canada of a company that's harnessing AI in a way to make the shopping experience more convenient, enjoyable, productive, and so have great admiration for that company as well.
All right. And thank you for that mention, Cathie, talking about a Canadian company, of course. That obviously warms our heart. I wanted to pick on the point you made about having proprietary data advantage, because as we know, these big techs, they have massive scale in their platforms, and they have a treasure trove of data to leverage upon that. So in your view, what does that mean for the competitive landscape? Are the leaders today going to maintain that competitive advantage, or will the future of AI belong to new players, or are there just going to be synergies that everyone can just sort of coexist together?
It really depends. We think some of them are in harm's way. A good example is Alphabet, Google. Most people think, oh my gosh, all the data it has between YouTube and search and understanding people's interests and so forth. Couldn't be a better company, couldn't have better data. The problem is 95% plus of Google's business is advertising based. And we wonder, and we actually do believe, that OpenAI is going to give Google a run for its money. So OpenAI, partly owned by Microsoft, this announcement was just today, actually, that they are going to develop a search engine going right after Google with using their own AI software expertise and Bing. Bing is not a very good search engine, but when you combine it with the AI expertise, we can see a situation where OpenAI is able to, with ChatGPT, let's just say that, or GPT-4, where can I buy this necklace by this designer for the most inexpensively with no shipping charges? It will take you directly to a website that might have even a used version of that. So we think that there's going to be disintermediation and more competition in a market that Google really has had to itself. And we think others are going to go after that market as well. And then if you want to talk about two others, so if you look at Amazon and Apple, so Apple forces everyone, developers, to pay a 30% tax when they put their apps on its platform. Again, AI could disintermediate that, just go directly to the website in response to a question. So that's also pretty interesting. Amazon, and by the way, we don't think these companies are going to go out of business. They'll have to pivot and try, but they're not going to have the market to themselves the way they might have had in the past. Amazon is in competition with actually Shopify in a way that Amazon probably didn't expect, because Shopify is capitalizing on social commerce. Well, Amazon is not a social network, whereas Shopify has tapped into each one of them. So again, Amazon won't have the e-commerce market as much to itself as it might have before. So we think there's more competition brewing here. The one company that we think is doing, has a very smart strategy now that it's pivoted from metaverse as its primary focus, is Meta Platforms. It is the leader in the open source AI movement. So OpenAI is despite its name, closed. It is a private company, and it doesn't allow other software developers from outside of OpenAI to develop to its platform. Whereas Llama 2, which is Meta Platform's open source model, large language model, is open. Any software developer can to write to it. And Llama 3 is going to come out in the next few weeks, we believe, and we'll see if it gives GPT-4 a run for its money. GPT-4 is by far the most performant of all of the large language models. But if we map all of the open source models out there, the open source models performance, while they're still below GPT-4, the improvement is faster than in the closed model. So Meta Platforms is leading the charge. Now, why would it do that? It would do that because these large language models are really enterprise solutions. Enterprises are looking to them. What is Meta Platforms' primary business? Most of it is consumer facing. So they are building on top of their own model, specialized models in-house to target the consumer space. So that's why that's so interesting to us.
Okay, that is some fascinating stuff, I do have to say. I do want to pick on another point on the qualitative side, and that goes back to the leadership at the helm of some of these companies. So, they're not, it goes without saying that they can run into controversy, and certain leaders make controversial statements. Do you think that can be problematic for investors, or how would you approach that?
Well, when we're asked that question, it's usually about Elon Musk, of course. And so we have a scoring system really focused on innovation that that is an overlay on our top-down and bottom-up modeling. The first metric in that 6-point scoring system is people, management, and culture. And so with Elon in particular, that score has been dinged once on the people side, not because of the crazy things he says out there. He has a right to say whatever he wants to say in our free speech society. But when he did write or tweet, now it would be called post, funding secured in 2018 to go saying, we're probably going to go private. That was not true. At least the courts believed it was not true at the time. Since then, he has won that case. But from 2018 through last year, most people thought that he had not been telling the truth. Through the court system, they found out that he was telling the truth. And but we did ding him at the time because the SEC was coming after him. We do not watch as much what they say or listen to as much what they say as we watch what they do, and around those 4 variables I mentioned, their domain expertise and barriers to entry, their AI expertise, their distribution, and their proprietary data.
Okay, perfect. So it's really what I'm hearing is that, you're separating those from them executing on their vision and their I guess their long-term plans on their business model that they have.
Right. Where are they pushing the frontiers of knowledge and technology forward faster than anyone else? And are they executing on the plan? Are they spending enough in R&D as a % of revenue? Are they spending it in the right places? Are they developing? Are the moats or barriers to entry, are they actually going up or are they coming down? Those are very important to us.
Okay. I'm glad you picked on R&D because that's where we're going to go to next. We want to talk about the quant side now. I know you said you have a scoring system you use for quali, and maybe, I don't know if you can share with on the quant side, but we're looking at company fundamentals. What are some financial metrics or ratios that you like to see or assess in AI stocks that may hint on the potential upside?
Well, again, a lot of a lot of our research is focused on, are they positioning the company to harness AI aggressively enough? So some of that is still qualitative in the way I just described. But what we're looking at, and there are a few companies out there who are falling off in our estimation, mostly because activist investors are getting involved, saying you're spending too much money on projects that aren't going to pay off for a very long time. And so when an activist investor gets involved and starts harvesting cash, we actually leave that ecosystem for the most part. Because the winners in AI are going to be those who are spending most aggressively now. In fact, they are sacrificing short-term profitability. Now, what are the metrics that we use? Well, the primary metric in terms of valuation that we use is enterprise value. So that incorporates both equity valuations and bonds. We want to look at the entire capital structure. Do they have too much leverage relative to their cash? And so we definitely want to evaluate that, of course. So enterprise value relative to EBITDA, earnings before interest, taxes, depreciation, and amortization in year 5. Not now. We want them to be actually sacrificing profitability now in order to be first in line. And in this winner take most world. And so we're looking at, and we assume that the EV to EBITDA ratio drops from wherever it is today. And it's very high, again, because they're sacrificing short-term profitability, to basically a small premium to the market, if not a market multiple in year 5, even though we don't believe that in year 5, most of these companies will be mature. We want to be conservative because we understand that this is a question about our strategy. What are the valuations? Are you being realistic? Can this happen in 5 years? And I will tell you today that if you give us 5 years, that our portfolios look like deep value portfolios based on our valuations.
Okay, so let me follow up this then with Cathie. When you talked about EV to EBITDA as a ratio and R&D spending, is there any particular sort of rules of thumbs that you look at in terms of the R&D spend? Let's take that, for example, compared to, let's say, the revenue that's coming in, or that ratio of EV to EBITDA, and what you want to see and how you want to see that improve?
Yes, so in R&D, the first thing we try to discern, to the extent companies are transparent about it, and they are more and more in the tech space, is are they spending those dollars in the right, no matter how much they're spending, in the right places? So to give you an example, in our early days of researching the electric vehicle market, which was the precursor to autonomous vehicles, we were trying to figure out, okay, is battery electric the right way to go? Or Toyota at that time was saying hydrogen fuel cells was the right way to go. And so we did our analysis at that level, saying, okay, well, wait a minute, which one is more realistically the winner here? And it turned out electric was going to be, because the infrastructure costs associated with hydrogen fuel cells was just prohibitive relative to electric. And I think that call was right. So that was the most important thing. Are they spending in the right places? And then it really depends industry by industry. I remember during the internet bubble, companies in the technology and telecom space were spending 25, 30, 40% of their funds in R&D as a percent of sales. But it was so undisciplined. That was crazy. And they were spending it in a lot of the wrong places because the technologies weren't ready and they were too costly. So we are very careful that, again, right direction, depends on the industry. We like to see double-digit R&D as a percent of revenues, but again, it depends on the industry.
Okay. Let me talk about revenue growth, because you mentioned you built a case where we're seeing big cost declines. Pricing powers, of course, are shifting. What does that mean for the top line numbers? And of course, you mentioned profitability is not something you look at. You've got a long-term vision, at least 5 years. So where are we headed with that when we're seeing the dramatic cost decline and what that's going to mean for those top line numbers?
Sure. I'll give you an overview of the disruptive innovation space generally in terms of these technologies. How quickly do we think they will grow? We think that number, this would be a top line like number, will accelerate as these S-curves start feeding each other, with AI an important ingredient there. That number is roughly 40% at a compound annual rate. So these are new technologies, sure, from a low base, but the base will grow, and that will be a big needle mover out there. And we also believe that margins will increase. So the bottom line should grow faster. Fighting that, a headwind to those two variables, is that valuation compression I described, which can be up to 20% per year. So again, we're trying to be conservative on the valuation side, but we are using our learning curves to understand cost declines, to understand how quickly a technology will proliferate to drive the top line assumptions.
Okay. Now, we'll continue on in just a moment, Cathie, but just for our audience, we have put up a poll on the screen for some questions for our audience members to vote on that you'd like for Cathie to take. So please do submit your options on which you'd like for her to answer, and we'll get to that in just a few moments' time here. Let's talk about valuations. Coming back to that, Cathie, these stocks have astronomical valuations, AI stocks. I mean, making heads or tails of it is a tough thing for a retail investor. So do you have any suggestions to help them assess if an AI stock is fairly valued, and how so?
Yes, so absolutely. Again, we've got that 5-year investment time horizon. I'm going to use NVIDIA as an example here. Phenomenal growth. It's going to report next week, probably. You know, it's against a very easy comparison a year ago, probably will look really good. But expectations are also very high. Our minimum hurdle rate of return for a stock to remain in our portfolio, certainly at a high position in the portfolio, our minimum hurdle rate of return expectation over the next 5 years is 15%. So it has to be north of that. Right now, NVIDIA is well below that in terms of our 5-year return expectation. Whereas some of the other stocks that I've mentioned, you know, most people don't understand how well positioned they are, especially in terms of proprietary data in this new world. And the return expectations for them are much higher than that.
Okay, perfect. That sums it up well, Cathie. All right, so last question as part of our interview portion, I'm going to ask you, this is going to be, you know, you've invested in emerging technologies, made a career out of it. You've seen the ups and downs over the years. There's no hiding the fact that it's a volatile industry. What's the biggest lesson you've learned in that time that you think investors should take to heart?
I think the most important lesson is you must have conviction based on research. And, you know, I have so much conviction. Many people describe us as a high conviction portfolio team. And the reason we do, and the reason we're able to withstand the volatility, is we keep our eye on that 5-year prize, that 5-year compound annual rate of return. And we are able, with each quarterly report, to pull information out of the quarterly calls and the quarterly reports themselves to gauge whether each company is on schedule. Are they harnessing these technologies quickly enough, or are they driving the cost down quickly enough in line with our models? So we have a lot of milestones along the way to say, yes or no, and you'll see if there is a key player in the company, a visionary we see leave, we will take the position size down. So again, conviction based on research, and making sure that those visionaries who are leading the companies are on track with these milestones, and that they themselves are still in place driving the strategy.
Absolutely. Okay. That is wonderful, Cathie. Thank you so much for sharing that with us. We are going to now get to our question and answer session. This is where we're going to get our audience members to chime in and have their questions answered by you. We're going to start with our poll. And you can see the audience member has voted on the poll question. We're going to see the one that's the most voted for. And let's start with, I believe that's question B. What are some good sources, i.e. reading websites, etc., to learn more and keep up to date with these developing technologies? So what would you say we can go for our learnings on this space?
You know, I want to be careful here, but our research, because it is our sole focus, and because we give our research away in many forms on our website at arc-invest.com, we give people through YouTube a weekly video called The Brainstorm that Nick Gruce, one of our associate portfolio managers, and Sam Corris, our director of research of autonomous technology and robotics, they summarize the brainstorm we have every Friday. That usually comes out on Tuesday. It's called The Brainstorm. We do podcasts. We do podcasts weekly, and those are full of it. We're interviewing CEOs from private companies, from public companies. We're interviewing experts. We do something called the Bitcoin Brainstorm monthly, and there you can tune into the brainstorm on YouTube, and you can see we're interviewing those people who are making this blockchain technology world happen, and you get to understand how blockchain technology and AI are converging in one of the sessions. It was a mind-blowing experience. I'm usually on that brainstorm. So, you know, my biggest source of information is our research, but I also listen to lots of podcasts out there. Andreessen Horowitz has a great podcast, so I listen to that. If Joe Rogan has someone involved in innovation, I love his in-depth interviews. Certainly, he pulled things out of Elon Musk has pulled
right,
things.
Yeah, I can remember that. Yeah, when they shot the arrow on the Cybertruck, right?
Yes. So yes, and so I think this space is moving so quickly that I like to. This is the other thing I like to do. If your viewers are interested in the research we're doing, what I do is I follow our analysts and I look at who they're following and see who interests me. You can develop your own little ecosystem around X by following people and learning who to follow to stay up with the latest and the greatest.
All right, perfect. And I know I've been a beneficiary of that. I've seen your work that you do on arc-invest.com. You've got fantastic articles. We can access your podcast in the know there as well, which is very insightful. So definitely recommend that. And certainly Twitter, or let's call it X now, which is the new, seems to be the new age learning platform. So we'll definitely check that out. The second question I'm going to address to you over here is by our audience member that's voted on. How do you compare current disruptive technologies with the likes of, let's say, BlackBerry or Nortel Telecom, which seem to be quite disruptive, but they were gone, that went awry, essentially. So what would you say to that?
Yes, again, this has to do with keeping up with the technology. BlackBerry, I don't think anyone took Apple seriously and this concept of a smartphone until the iPhone came out. And then it was too late because they hadn't started their R&D on it. And of course, they all tried to catch up. One of BlackBerry's biggest advantages is that chief technology officers trusted it from a security point of view. And so for a time, we thought that chief technology officers would not allow iPhones into their ecosystem. Well, guess what? After CEOs and CFOs went to the CTO and said, I am using iPhone. I want to be able to use, and we're getting all kinds of requests from our employees. This is a much better product. I can get so much more on this platform. That was what went wrong there. And in terms of Nortel and so many telecom providers, build it and they will come. Well, so much capital was raised in the broadband space that, and this often happens, and there is a risk in AI that there are some parts of AI that are going to fall victim to the same thing here. There was so much capital that flowed into building out broadband that that the returns on capital collapsed. It was just too much, too soon, before we even had the cloud. The cloud didn't really come about until 2006. Before we had artificial intelligence, the big breakthroughs, as I mentioned before, right. 2012, 2018. So way too early. And so that was a timing issue, I would say.
Okay. All right. Let me get to another question here. This one's coming from our audience member, Wei Lan. The question is, does PE valuation matter in evaluating these AI-related software companies? I know you spoke a bit about that, but if you could directly speak to it some more.
Yes, it does. But if you're talking about valuation today, we care much less about that, especially if a company is spending aggressively in R&D to separate from the pack and sacrificing short-term profitability to do it. We care very much about its positioning in the marketplace that will get it to the winner take most territory by year 5. And we, as I mentioned, we want to, given our cost decline and price elasticity of demand assumptions, if we believe that the revenue acceleration and the margin expansion is going to overcome the valuation headwind by more than 15% at a compound annual rate, that's interesting for us. So we absolutely think about valuation critically. It is one of the 6 metrics that overlay our top-down and bottom-up modeling. But we care about it in year 5.
Okay, that's fascinating stuff. Thank you so much, Cathie, for sharing your insights. We will have to draw our session to a close for today. And thank you to everyone for joining our Inside Investing show. But before you go, Cathie, I'm going to give you a big, extra big thank you, of course, for taking the time chatting with us, letting us into the deep and insightful thoughts that you have on this space and your research process. We certainly look forward to hosting you again in the not so distant future to do see the check how we're doing in the 5-year space that we have. And for those in our audience also, of course, thank you for tuning in, your participation, and as well as sending in your questions. We appreciate that we couldn't get to all of the questions in the amount of time that we had today. So thank you again, once again, though, for your participation.
And that wraps up our insightful interview with the one and only Cathie Wood. We hope you found tons of value in her bold visions for the future of artificial intelligence and disruptive innovation. To quickly recap, Wood shared her maverick perspectives on why AI will be the most transformational innovation ever, catalyzing breakthroughs across sectors, how she expects advanced AI to emerge within the next 5 to 8 years based on rapid progress, what leaders like Tesla and Palantir are doing right now to leverage proprietary data and expertise to cement competitive edges. She also revealed the financial metrics and growth forecasts that her firm RK Invest uses to evaluate innovators. This gives us a blueprint for identifying tomorrow's giants while they are still small emerging players. The overarching theme is that AI and disruptive technologies will revolutionize major industries, creating phenomenal opportunities for smart investors. But we must act wisely, spotting those dancing with disruption rather than those about to be disrupted. Cathie Wood has proven herself as an investing visionary time and again. Her wisdom and research give us an exclusive inside track for finding exciting growth stocks before they explode in scale. We hope you found a stock, an industry, or an insight to dig deeper into from this conversation. The possibilities AI unlocks are endless. But as Wood reveals, those possibilities only bear fruit for companies taking the right strategic actions today. Thank you for tuning into InvestMinder and engaging with this powerful interview.
Hope you found today's analysis helpful as you look for profitable new stock opportunities. This was InvestMinder. Remember, knowledge equals profit in the stock market. Thanks so much for watching, and please hit that thumbs up button if you got value from this video. Make sure you click to subscribe as well to get our next videos when we reveal the best new insider stock purchases. Invest wisely, trade carefully, and we'll see you next time. Disclaimer: InvestMinder is an independent stock market commentary channel for entertainment and basic informational purposes only. We are not licensed financial professionals and do not provide personalized investing or financial advice. P.S. If you stayed watching until here, you are awesome. Thank you for enabling me to keep making these videos with all the likes and subscribes. Have a great day, and we love you all.